Welcome back to Primary Source China Investment. This week we're on show D7. And if you recall, last week we were talking about what we do takes an equal measure of optimism and skepticism to stay objective. And this week we're leaning a little bit more on the skepticism. China PPI has been deflationary for 23 months. And this just doesn't affect Chinese companies. The EU Chamber of Commerce came out with a survey recently that said 70% of respondents thought that overcapacity in their industry had driven down prices. About 44% of respondents were also pessimistic about their likely profitability over the next 2 years. That's a record high. 52% said they would be reducing costs in China, and a quarter said they would be reducing headcount. What about the Americans? Well, the American Chamber of Commerce had business optimism fall to an all-time low. This is all the foreign companies reporting that they are facing rough sledding. And there's a number of factors. We've talked about them over many, many months. But the talk of deflation is also back in the news in China. It probably should have never left. Consumers are changing behavior, and consumers are demanding some respite. There's a mortgage interest rate proposal that would cut 50 basis points on a mortgage rate. The mortgage industry in China is about 38 trillion renminbi. Will mortgage holders spend that 190 billion savings elsewhere? Maybe, but that's an annual number, and it sounds big until you compare it to GDP. So GDP is 127 trillion. 190 billion is like 1/10 of 1%. Also, the mortgage market is shrinking in China. The other notable thing that came up this week was the raising of retirement age. China currently has a very young retirement age, and those ages are going to creep up over the next 15 years. This probably doesn't move the needle in the short term, and it probably crowds out younger workers from gaining those plum SOE jobs. China's current population of 50 to 60-year-olds, this is the cohort that's being affected, is 17%, and the cohort of 20 to 30-year-olds is 11%. So I'm going to leave those two big policy issues there, Peng Guo, before we get into some of the capital formation issues. Any comments on those two proposals?
Yeah, I think people start to talk about deflation. And according to National Bureau of Statistics number, in the manufacturer side, the price really get dropped 1.8%. In the consumer side, generally speaking, the price just increases 0.6%. So you can see the price is pretty much not a big change. But a good news is overall, in August, the entire industry value, the growth is still okay. It's 4.5%.
Mm-hmm.
So compared to the previous months, is they still keep the growth rate around more than 4.5%. So
You mean
uh,
for overall GDP?
overall the industry value added.
Okay, all right.
Yeah, and in this area, you can see like the clean energy car and a robot and other high-end manufacturer-related product. Their growth rate are probably around 6 to 8%. Others is pretty low, is around 3 to 5%. And especially for the foreign investor and Hong Kong related companies, their growth rate is really 2.8%. That looks like a lowest one.
Yeah, so that leads us to this chart that it really explains a lot. Capital investment and company formation is dead on arrival. The immediate conclusion from these charts is that entrepreneurship has evaporated. But the converse of that is that SOE expansion is rising. You can see the invested in dollar-denominated funds or renminbi funds or Chinese or companies founded, it is all plummeting. And yet, China's top 500 enterprises are seeing steady growth, exactly to your point, Peng Guo. Here's a list of these top 10 names and their growth over the last years. And without doing the translation, you have the electric companies, the bank companies, the oil and gas companies. These are large SOE companies on the mainland in China. So investors who are enamored with the Pinduoduos, the Alibabas, the Jingdongs should immediately stop, look, and listen. We've been saying it for almost 3 years. You can see the divergence in the top SOEs versus the broader market. Here's a 1-year chart. You can see this massive divergence, the red line and the blue line here. This is another crowding out effect of SOEs. When an SOE is a favorite, gets a favored nation status domestically, however you want to call it, they are going to dominate. The point here is it's not great. These SOEs are still down for the last year. I just pulled a 1-year chart. These are down about 6%, which is a lot better than being down 13. The other point I just want to make here, Peng Guo, is that the US ETFs, MCHI, KWEB, are both down 9% over the last year. So you have a winning strategy with these large SOEs. And those large SOEs are easy to find. They're the power companies and the big bank companies and the oil and gas companies.
I think there's a lot of comments about the Pinduoduo as such online retailers. But no matter what happened, American definitely should appreciate Pinduoduo. This is significantly reduce the inflation in the United States.
Yeah, I don't know. I was taught a very early lesson. Sometimes, you get what you pay for. So if there's a lot of pushback on fast fashion in general, and even before Pinduoduo came around, this idea that, you wear something 1 or 2 times and it ends up in a landfill. I think there is the dark side to having fast fashion, quick and easy.
Yeah, but without it, I bet the United States inflation rate could increase another couple of the percentages.
Yeah. I mean, that's also the question. I mean, American consumers, they love to have a lot of times they love to have a lot crap. I mean, how many T-shirts does the average teenager need? 30 years ago, the average
right. Yeah.
they don't need 50 T-shirts. But anyway, that the consumer is going to do what the consumer is going to do, and they're going to make their choices. But the fact of the matter is a lot of those stocks, they may be becoming more high-profile names, whereas names like we keep talking about China Merchants Bank, these are names that don't come up in conversation a lot, and these are companies that are going to do well regardless of the economic headwinds.
That's all state-owned companies.
Yeah, but that's the market. That's the market, right? That's the market that we're in.
That's true.
Yeah, that's you can fight the trend, but it doesn't make a lot of sense. And a lot of those U.S. listed or even Hong Kong listed Chinese companies, they do have a lot of volatility, and a lot of them don't necessarily trade on fundamentals. They trade on supply and demand.
That's right.
Well, we're going to leave it there for show D7. Thanks for tuning in, and we'll see you next week.
Thank you.